How to value or not value dividend streams. This lesson has two learning objectives. The first one is why dividends are often misunderstood. And the second learning objective is if dividends are important for stock valuations. If you've ever worked with stock valuations before, you've likely heard that the intrinsic value of a stock is the discounted value of all future cash flows. So please do not be discouraged if you don't understand exactly what that statement means. Whenever I was starting out, I didn't understand what it meant, and I clearly remember reading that. But I want you to know that we're going to elaborate on this statement over and over again in this course. But for right now, I think this is the best way for you to think about that statement. Think of it like this. The more money a company is making, the more its stock is going to be worth. And I know that sounds really generic and simple, but that's really what that statement is getting at with the intrinsic value. One of the most common mistakes in valuation that I see is to put too much emphasis on the dividends. The concept of dividends is really quite simple. It's the amount of cash that the management of the company distributes to the shareholders of the company. So if you buy one share of stock, and you own that and the management decides to pay a dividend, you will receive a dividend on that one share of stock. Okay, so let's do an example here. Let's say that there's a company that makes $200 in profit and that there's 100 shareholders for that company. So if all of that profit would be paid out as a dividend, each shareholder would collect $2 for each share that they own. So in that scenario, our company paid out 100% of the profit or the earnings as a dividend. And you might be thinking, well, how often does that happen? And the answer is almost never does that happen. In fact, some companies don't even pay a dividend. They just retain all that money in their corporate account, and then the company becomes more valuable. So what's important here is that not all managements use the same rules for paying dividends. Some are going to pay a lot of the profits out in dividends. Some will pay literally nothing out in dividends. The thing that's important is, let's say one company pays a lot and the other one doesn't pay any. The one that's paying a lot isn't worth 4 times as much as the one who doesn't pay anything. So what's important for you as an investor to fully understand? The first thing I would say is you got to understand what a dividend is. The second thing is you got to understand what a dividend indicates. And then the third thing is what should you take away from this dividend discussion regarding stock valuations? So let's talk about the first one and let's talk about what a dividend is. So a dividend is a cash payment that's paid to the shareholder. When the company pays out that dividend, think of it very simply. If you own part of a business and that business is making money, you as the owner, the shareholder, should expect to receive some type of cash payment as profits are being made. If you don't receive a cash payment, that money should continue to accumulate in the corporate account of the business, which is adding more value in the stock price as you continue to own it. So the second point is what dividends indicate. So one of the things that I look at whenever I see a company is paying a dividend is I look at a thing called the payout ratio. So what the payout ratio is we were talking earlier that the company makes a profit. Let's say that one stock makes a profit of $1 a share. And if the company is paying a 20-cent dividend, you can see that 20 cents is coming out of that $1 of profit. So the payout ratio in this scenario would be 20%. And so the thing that I'm looking for whenever I'm looking at a company is the payout ratio higher than what the company's making is as a profit. So in the scenario before, if the company was making a profit of $1 and the company was paying a dividend of $1.20, we know that that's not sustainable. Now they could do it if they have cash in their account to make that payment, but they couldn't do it consistently over and over again. So what I typically look for whenever somebody says, hey, there's a stock pick of whatever, and it has a really high dividend, my immediate thought is that dividend sustainable? And what's the payout ratio? Is the payout ratio higher than 100%? Because if it is, I pretty much know that that's not going to be a sustained dividend payment, and you're probably going to see the stock price get totally crushed whenever the company stops making those huge dividend payments. But that's what I'm looking for. Is the dividend a sustainable payout ratio? And so what I would consider a normal payout ratio is probably around 30%. 40% would be maybe getting on the high side. For most companies, they like to retain a little bit so that they have some maneuverability by retaining profits. But those are some of the things that I think through whenever I'm looking at a stock pick. So something else that's important is that the more mature companies typically have higher payout ratios. If you're a new startup and you're trying to really grow, this is where you might expect to see a company with maybe even not even paying a dividend because they're trying to retain as much profit as possible so they can continue to grow the company organically by investing in assets that they control. When you get into some of the larger companies, the ones that have been around for a really long time, they're the ones that are most likely going to have a dividend and probably have maybe a higher payout ratio because they're much more stable. They can't employ the billions of dollars that they're earning every quarter, so they want to give that back to their shareholders. And so this is what some of these dividends indicate whenever you're looking at different companies. So this is the one thing that I'd tell you to look out for. If you come across the company that has a high payout ratio, let's say it's something like 70 to 80% of their earnings, and they have declining earnings or they have pretty flat earnings, and they're taking on more and more debt, or they are selling off assets, I would tell you to be very, very careful buying a company like that. You want it to be within reason. You want it to seem like the company's balanced with the dividend payments that they're making. And you know what? If the company's not paying out as much as they could, that's not necessarily a bad thing either, because you might be saving some money on taxes, and that could go into a longer discussion. But in short, as a shareholder, you actually get double taxed. The company gets taxed as the money leaves to you as a dividend, and then you pay a tax again whenever the money hits your account. So as you'll see later in Module 3, earnings can be easily manipulated. And the good thing about dividends is that they tend to validate the earnings. Dividend payments are hard to manipulate since it's cash that will be removed from the company's balance sheet and into the shareholder's account. So you can typically be quite certain that a stable company with consistently high payout ratios indeed have good cash flow, and it's not just posting short-term earnings results to boost the share price. So a lot of the times I pay very close attention to how the company is handling those dividends, and I'm kind of scrubbing that dividend payment with the financing section of the cash flow statement to make sure that all of that money that's being paid to me as a shareholder is coming from the organic business. It's not being financed by the sale of more stock or by taking out loans in order to raise cash so that they can make their really high dividend payments. That's kind of where you're looking at, is where is this cash coming from? Is it coming from the sale of their goods and they're producing profit? And if so, is it sustainable? Is the earnings being consistent? Those are some of the really key important things that dividends indicate to the shareholder. So this is what I suggest that you take away from the dividend discussion regarding valuations. I think you should be skeptical about putting too much emphasis on dividends. As you'll see later in this course, the formula that we're going to be using for estimating the intrinsic value doesn't even rely on dividends. Instead, what we're really valuing is the profit, but you can go back and you can validate based on some of the discussion we had on the previous point. Are those dividends sustainable? Is it kind of giving you a clue as to is the company trying to manipulate that earnings number that we're going to use later when we're doing the intrinsic value calculations? So in other words, the discussion about dividends regarding valuation is not really relevant, since as an investor, you would most importantly want the dollar to be invested where it generates the highest return. So if the company can reinvest the profits because it's not paying a dividend like Berkshire Hathaway in its own existing business, it should do that. If Warren Buffett's getting a 20% return, which is his average annual return, you don't want him to pay you a dividend because you want him to get you 20% on that money that he's retaining. But if the company isn't getting such a high return on the money that it's retaining, you should want that back as a dividend. So Warren Buffett's business partner, billionaire Charlie Munger, had pointed out several times that Costco paid no dividend when it was growing rapidly, since it needed every dollar for profitable growth. He also pointed out that any investor wanting to dilute the value of Costco because it didn't pay out dividends would have been completely wrong, and that's probably the wrong way to look at it. Instead, let Costco invest the money because they were getting huge returns at the time when he made that statement. So your takeaway as an investor should be to be aware of dividends before you start estimating the intrinsic value of a stock. A very high or a very low payout ratio might raise some concerns, and it's probably going to give you some cluing into what is the company trying to do right now. And that's a smart way to think about dividends when you're making that assessment of intrinsic value. And so the same can be said of a very unstable dividend payment unless it's a company and management you believe in. And in the second module of the course, we'll look close into how to quantify those concerns and beliefs in a formula.